At the start of the year, Lateline Business asked 5 leading market economists where they thought financial markets and the economy would be at the end of 2010. With the 30th of June marking the close of the financial year, we've checked in with our experts to find out how their forecasts are standing up in turbulent times. Andrew Robertson has this assessment.
This is the best sale of the year, mate.
At the beginning of 2010, confidence was in the air. The stock market was continuing its stellar run, which began 9 months earlier. The global economy was on the way back, and in Australia the commodities boom was taking hold again. But 6 months can be a long time.
The underlying economic outlook in Australia is really little change from where we thought it would be 6 months ago. But the big change has been the sovereign risk issues, the government debt issues in Europe, which have made investors very nervous.
And that nervousness has played out on the stock market, which has shed 6% in 2010 and also shredded the forecasts of Lateline Business's experts. In January, even the bears were tipping 5,000 by the end of December, but with the market now languishing at around 4,300, all have revised their predictions down. That's the bad news. The good news is that those revised forecasts indicate they're all predicting a much better second half to the year.
Well, I think the earnings outlook is still very good. Underlying momentum in growth is still there. None of that's changed. If you look at the Australian economy, it's doing very well. We've averaged growth of close to 1% for the last couple of quarters.
If you think about the share market today, it's trading at about a 20% discount to long-term average valuations as measured by the price-to-earnings multiple. On top of that, we're looking at 15 to 20% earnings growth.
The Australian dollar has taken a battering over the last couple of months, as has all the early year talk of reaching parity with the greenback. The local currency is currently sitting at around 85 US cents. By his own admission, Shane Oliver's early year prediction of $1.05 is now dramatically underwater, with only ICAP's Adam Carr, who was our most conservative forecaster, sticking with his original prediction. But as with the stock market, those end of financial year looks into the crystal ball reveal optimism about the next 6 months.
The biggest driver of that really is what's happening in the US economy and with US monetary policy. So at JP Morgan, our US economists don't expect the Federal Reserve to start adjusting monetary policy now until the fourth quarter of 2011. And I guess the reasoning in terms of the implications for the Aussie dollar is that should mean that the US dollar is sort of going to struggle to get any genuine support.
Our experts' confidence about the recovery of the Australian economy and the interest rate rises that would flow from that have proved correct. The bad news for business is that all 5 now expect the official cash rate to hit 5% by the end of the year, with Westpac's Bill Evans and NAB's Rob Henderson raising their forecasts.
But we have seen a new development on the interest rate front, and that's higher than expected inflation, and I think the Reserve Bank will be very concerned about that.
We are expecting 2 late increases in interest rates of 25 basis points each in November and December, so that'll take us from 4.5% to 5%.
Which is a reflection of the improving strength of the Australian economy, as is the high level of employment. On that front, Rob Henderson is the most optimistic, but all our experts are tipping unemployment to be just above or just below 5%, not dramatically different from the current level of 5.2%.
The labour market is continuing to do pretty well. So we see jobs growth on average of about sort of 15 to 20,000 each month for the next 6 months or so.
With the export sector growing aggressively as it has, the retailing consumers doing very well, I think the underlying fundamentals are very positive.
They'll have to stay positive for our experts' predictions to be travelling well by the end of the year, and that's when we'll check in with them again to see how they fared.